This is Macro Horizons, episode 371, Stability Despite Uncertainty, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of April 27th. And as we approach what could very well be Powell's last FOMC meeting as chair, we only hope that he sticks around long enough to enjoy the renovations. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market held a remarkably narrow range given everything that is going on the geopolitical front. Between the war in Iran, the ongoing trade war, the uncertainties on the tariff front, and elevated energy costs continuing to ripple through the global economy, it strikes us that the Treasury market has found a bit of an equilibrium with 10-year yields anchored to 4.25. Now, the range that we'll be watching is between the 200-day moving average in the 10-year sector, which is 4.18, and the upper bound of the local range at 4.40. Now, it's clear that such a range cannot persist indefinitely, although given the flow of headlines out of the Middle East and the market's relatively muted response thus far, we're operating under the assumption that there'll be no compelling reason to break the range, at least not ahead of the payrolls print on May 8th. Now, note that we're assuming that the range makes it through the upcoming FOMC meeting on Wednesday afternoon, in no small part because there is no updated SEP, and we expect that Powell's message will be very consistent with the idea that policy changes remain on hold and the overall economy is relatively stable, all things considered. The week just past also showed the highest ADP weekly jobs gain number on record, keeping in mind that the record only goes back to early 2024. Nonetheless, when combined with the initial jobless print in the low 200 range for NFP survey week, expectations for April's payroll growth will be solid if nothing else. The shape of the yield curve remains topical. The two-year sector is, for all intents and purposes, reflecting no rate cuts for the foreseeable future, which suggests to us that anytime two-year yields make an attempt to push towards 4%, that will be a buying opportunity. But at 380, given the competing narratives of inflation and growth, we'll characterize the pricing in the front end as fair. Now, we do ultimately assume that at some point the Fed will resume normalizing rates, but the near or medium-term inflationary implications from the war are difficult to ignore, and as a result, we're sympathetic to the market pricing out rate cuts for the foreseeable future. The 530s curve steepened out throughout the first half of April, eventually breaching the 200-day moving average of the curve, which is effectively 103, only for that challenge to fail, and we've seen a steady reflattening since then. There's an opening gap that comes in the mid-90s range that we're using as our interim target for 5s bonds. We're certainly cognizant that the curve steepening bias that was held by many at the beginning of the year has met with little satisfaction, and as a result, our expectations are that the curve will grind sideways along with the balance of the Treasury market until there is either resolution to the blockade of the Strait of Hormuz or there's a material shift in the trajectory of the U.S. economic data.
Well, the highlight of the week, in addition to another delay of a ceasefire, which begs the question, how many times does a fire need to be ceased before the war is over? We saw a very strong retail sales print, with the highlight being the control group, as well as incoming Fed Chair Warsh's testimony ahead of the Senate Banking Committee, that all combined to leave a moderately bearish tone in the Treasury market, although in this case, moderately bearish still has left 10s comfortably below 440, and frankly, our biggest takeaway was that the magnetism of 425 remains firmly intact, as investors are either sidelined, given the impression of the value of rates at these levels, or unwilling to deploy risk, for fear of the next headline out of the Middle East, offering some sort of surprise on the likelihood that either the blockade of the Strait of Hormuz continues, the talks in Islamabad fall through or go ahead, or, frankly, anything that derails what has been a return to a grind lower in volatility. This is the backdrop that the market is starting to consider the growth negative implications of higher oil prices, as crude back above $100 a barrel is going to be meeting a growth backdrop that is nothing if not solid. After all, the domestic consumer in March was nothing if not strong, if retail sales is any indication. That represents at least some capacity to withstand higher energy prices as summer approaches, and gives a little bit longer runway until policymakers will likely really start getting concerned about the state of the expansion.
And to be fair, the resilience of the U.S. economy remains intact, and that does provide plenty of flexibility for the Fed to wait and see the degree to which elevated energy prices ultimately flow through to core goods. There have been increased concerns about fertilizer costs translating through into future upside risk for the food component of the consumption basket, although, as you point out, Ben, the U.S. consumer appears to be on solid footing, even as the war continues with no clear end in sight. The question then becomes whether or not the energy sector is due for a repricing to even higher oil prices. Frankly, it's been somewhat surprising that after the initial spike in oil prices, there seems to be a degree of comfort with the front-month WTI contract between $90 and $100 a barrel. If, in fact, this is the new normal, it becomes less of a headline inflationary worry for April and May, and more an issue of whether or not there's consistent pass-through to core prices. Again, it's an unknown, and it's one that's going to keep monetary policymakers from messaging any shift for the foreseeable future. We also saw a solid reception to the 20-year auction, which stopped through a full basis point. But again, the market is very much in the mode of trading the range. So it wasn't surprising to see limited follow-through for the market in that context. Equity prices continue to set fresh record highs, which contributes to the wealth effect, and again, reinforces the notion that consumers will continue to spend as long as the employment market remains solid, even as there is an increasing number of macroeconomic uncertainties stemming from the war in Iran.
And in his hearing in front of the Senate Banking Committee, Warsh emphasized precisely that dynamic, that it's an uncertain time, and given the Fed's mandate, there needs to be a focus on both the labor market and the upside risks to inflation. Unsurprisingly, the committee's line of questioning focused heavily on the impact that President Trump's encouragement for lower rates will have on the Fed under Warsh, and while it was always an extremely low probability that the incoming Fed chair would acknowledge the political pressure he will be under, his messaging was very clear in that in order for the central bank to operate efficiently, it needs to be apolitical. However, there was also a lot of discussion around alternate measures of inflation and some criticism by Warsh that the current benchmark of core PCE doesn't completely capture the realities of inflation that consumers are facing, and so the emphasis on some trimmed mean metrics and other indices that Warsh will look at will argue are already laying the groundwork for Warsh to make the claim that inflation is not as bad as it might appear from a core PCE perspective. This, along with his criticism of forward guidance, particularly in the current macro backdrop, reinforce what we expect will be a persistent easing bias, even if a delayed easing bias, under the Fed with a new chair. Now, it's probably too soon to claim that we're going to see a removal of the SEP and no more dot plot, but clearly Warsh's opinion of the efficacy of forward guidance from the Fed is fairly low, and we expect that it will be further de-emphasized, even after Powell has done some of the same, once he officially takes over.
And that's another uncertainty that's plaguing the market at the moment. When will Powell exit as Fed chair? To some extent, it's going to be contingent on whether or not Tillis continues to block Warsh's confirmation, which we maintain will likely remain the case until the DOJ probe is dropped. And as a result, while Wednesday's FOMC meeting is expected to be Powell's last as Fed chair, there is a potential that he holds that position into the summer months in the event that Warsh's confirmation is held up. Now, we certainly don't expect Powell to remain Fed chair indefinitely, but there's clearly a risk that at the June meeting he's still in charge. On the margin, that's probably incrementally hawkish, but it's more about not seeing the dovishness which Warsh might bring to the Fed once he takes over the reins.
And the price action in the equity market is also worth highlighting over the course of the last week, with several benchmark indices setting new all-time highs and obviously more than retracing the sell-off that characterized the early part of March. which comes at an especially relevant time given the broader financial conditions backdrop and the fact that yields continue to hold to a very well-defined range. The MOVE index continues to grind lower, as does the VIX, and as we think about the combination of easier financial conditions resulting from that price action, along with the aggregate of the economic data we've gotten for March, CPI, NFP, retail sales, all this points to a monetary policy backdrop that, from the Fed's perspective, is in a good place. The unemployment rate remains low, inflation is not showing signs of meaningfully reaccelerating, and so this begs the question of how responsive the Fed is going to be to upside risks to inflation and downside risks to growth on a forward-looking basis. The driving while looking in the rearview mirror analogy is apt here, as the Fed will likely be reluctant to overreact either hawkishly or dovishly until there is a clearer sense of how the real economy is responding to higher oil prices. But for the time being, it might not be quite a Goldilocks scenario, but the market and broader financial conditions have done a fair amount of easing for the Fed that diminishes the urgency around the next rate cut, at least for the time being.
And still, the employment market remains relatively strong overall, even as we continue to debate what the right number for break-even payrolls growth is to keep the unemployment rate stable at a low level. Now, we do have our reservations that the drop in the labor force participation rate might be weighing on the unemployment rate itself in a way that ultimately resolves in a higher unemployment rate if labor force participation increases. But for now, it's difficult to argue with the Fed's assertion that the labor market is stable. We anticipate that this mantra will be repeated on Wednesday, both via the FOMC statement as well as Powell's press conference. Questions in the press conference will surely focus on the fallout from the energy spike associated with the war in Iran, as well as the overall health of the consumer as the Fed maintains policy rates in what most view as slightly restrictive territory.
And in this vein, we've had several client conversations this week around the hypothetical of what it would actually take for the next move from the Fed to be a hike. Here, we'll look not to the inflation backdrop, because while yes, there's been a lot of progress in bringing inflation lower, what we've learned is that that has been deemed good enough to keep an easing bias entrenched. And so between the upside risks around oil and simply the departure point in the outright level of inflation, it would not be a change there that would put hikes on the table, but rather what we would need to see is a more material acceleration, not just status quo, dynamic in the labor market. So what that would look like is an ongoing decline in the unemployment rate, continued upside surprises in terms of headline NFP, more dialogue around this potential idea that the break-even jobs growth rate is in fact lower in the current paradigm, and all of this would ultimately resolve in renewed upward pressure on wages. It's the potential for a reacceleration in average hourly earnings that puts a true demand-driven pickup in inflation back on the table that would represent the type of inflection which could potentially call into question just how restrictive monetary policy is. After all, if the labor market resumes tightening and wage growth picks back up, it's difficult to make the case that monetary policy is having an economic cooling impact. Now, this clearly is not our base case, but especially given the dramatic repricing we've seen in the very front end of the curve since the outbreak of the war in Iran, it's worth considering what could potentially be required to put a hike back on the table. At this point, the longer-term trajectory of labor demand and the broader level of uncertainty makes that unlikely, but it's at least something to consider as we head into next week's FOMC meeting.
And you make a very good point, Ben. At this stage, nothing should be off the table, except for your feet. In the week ahead, there'll be several key macro events that will set the tone for treasuries. There are 3 key treasury auctions that have been brought forward because of the timing of month end. We have $69 billion 2 years auctioned on Monday morning, followed by $70 billion 5 years on Monday afternoon. Nominal issuance for the month is capped with Tuesday afternoon's $44 billion 7-year auction. All of these auctions we anticipate will be reasonably well received, particularly 5s and 7s. However, in light of the uncertainties regarding the monetary policy outlook, we're comfortable with the notion that the 2-year auction results will be a barometer for general demand for the front end ahead of the Fed. The FOMC decision on Wednesday afternoon is expected to yield no change to the policy rate. That is very consensus at this point. In fact, the market is pricing in no rate cuts for the balance of the year. Now, we do not expect that Powell will be willing to commit to any course of action for monetary policy. If for no other reason, then this could be his last press conference and his last meeting as chair of the FOMC. There's no updated SEP, and we expect that forward guidance will not materially change. There will, of course, be questions regarding the war and its impact on both inflation and the pace of consumption. However, in light of the data that we have seen thus far, we suspect that Powell will reserve judgment and simply reiterate the notion that the real economy remains on solid footing, all things considered. In terms of economic data in the week ahead, Thursday provides the biggest highlight. We see core PCE for the month of March. Here, the consensus is for a 0.3. So in practical terms, that translates through to a low 0.3 or a high 0.2. We'll also have the first look at Q1 real GDP. Here, the market is looking for a 1.3% gain, which is an improvement from Q4, but still modestly below potential. Within the details, the market will correctly be focused on the pace of consumption, particularly in the month of March, given the potential fallout from the conflict in the Middle East. When combining this all for a near-term trading bias, it's difficult for us to assume that the range is going to break anytime soon. While we do eventually think that the 10-year yield is going to trade with a 3 handle, it certainly won't be this quarter, and it probably won't be next, at least not until there's resolution to the war in Iran, and the market has a greater understanding of what this all means for the U.S. consumer and the pace of the expansion. We'll also, presumably, have a new Fed chair at some point, and Warsh's efforts to reform the Fed will most likely translate into a modestly dovish bias, or at least that's investors' expectations for the time being. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with spring and the allergy season setting the agenda outdoors these days, we find ourselves notably thankful for the office's HVAC system. Sometimes there's just a little more work that needs to get done. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.